And today's topic, as announced yesterday, is investing in REITs, also known as real estate investment trusts. And I have with me today a very special guest, the lovely Rose Baker, and who I will introduce to you shortly. And she's an expert in this area. And in fact, I'm just going to pull up Rose's bio to read to you. Give me 1 second. Okay, Rose Baker works in a private equity firm specializing in real estate-based investments, also known as REITs. Rose began her career in the commercial insurance industry, specializing in real estate development, construction, and property insurance. Always having a personal passion for investing and uncovering new investment strategies, it was an easy transition into a career in private equity. As an investor and an employee of Equiton Capital, a private equity firm, and she'll explain to you what all that means. She will further explain all the ins and outs of both public and private REITs, how to do a proper due diligence as an investor, and how to get involved with investing and all the benefits that REITs have to offer. So thanks again very much, Rose, for agreeing to join us today for this webinar. And welcome. Can you hear me okay?
Thank you for having me.
My pleasure. Your volume is a little low. I don't know if you can up your volume on your end.
Yeah, let me see what I can do here.
And everyone, if you have any questions, please put them in the comments section. We may not be able to see them while the video is live, but we will make sure to check for any comments and questions at the end. Okay.
Is that better, the volume?
Slightly better, Rose. I don't know if you can come a little closer, perhaps.
Is that okay?
Yeah, you may have to just speak loudly. Can you hear me okay?
Yeah, no, I can hear you great.
Okay. I mean, I can hear you, but it's just a little faint, that's all.
Okay. I'll try to speak loudly for you.
Thank you. Okay.
So yeah, thank you for having me.
Sorry, what were you saying?
I was just going to say thank you for having me today to join you. I'm looking forward to it.
My pleasure. And I know you prepared a few slides for us. Are you able to pull them up?
Yeah, absolutely. So what I can do is I'll share my screen here.
Yeah, and I'm gonna make you a host so you can do that. Okay. Yeah, okay. Now you should be able to share. Okay.
There we go. You can see that okay?
Yes.
Perfect. So to start out, I'm going to just start from a very simple, basic perspective of exactly what REITs are, how you get involved with them, the different sort of avenues you can get, have access to them, and sort of the benefits of either or. So to define a REIT, I mean, they're very broadly defined. It's quite a broad term. There's a lot of different shapes and sizes for REITs. So it's a particular investment instrument. Essentially, the strategy of a REIT is a company purchases, finances, organizes, and acquires real estate assets, and they hold those assets within a trust. Then investors raise capital, or I guess capital is raised through investors, and that capital is used to purchase real estate assets and then included within that trust, and then the investors share a pooled ownership of all of those assets. So again, because there is so many different kind of REITs out there, it's important to always do your due diligence before you invest in any investment at all, and especially REITs. You can either get them through the public market where they're traded daily on the stock exchange, or through the private capital markets where they're referred to as real estate mutual fund trusts. So they're very similar products but have very different benefits and components to them. That's essentially a rundown on REITs. I mean, there can be, residential, commercial, industrial, there can be lending, any sort of real estate based investment option can be held within a REIT. So just to discuss a little bit about REITs and the benefits that have come along with them. So it's really important to know, what you're getting involved with. As I mentioned, there's so many different kinds of REITs. So you want to make sure you are aware of the demographics. Is it 100% Canadian owned? Does it have USA exposure? Is it international? What kind of assets do they have under management? What do they foresee? Is it an open-ended fund, which means you can get into it any time? Or is it a closed-ended fund, which means they raise capital up to a certain point and then close the fund and new investors can't have access? So again, there's a variety of different REITs. The main quality about REITs is they offer investors a lot of benefits. So some of those are cash flow. So whether it's a public REIT, they would offer something called a dividend, and privately, it's often called a distribution. So this offers you a very stable and competitive cash flow on either a monthly, quarterly, or annual basis. They're very risk adjusted and stable, as I had mentioned. Also, getting involved with REITs is important to know the liquidity and how long of a hold is suggested for this type of investment. Public REITs are considered very liquid products because they are traded daily, when private REITs sometimes aren't as liquid and there's a different redemption process. So it's very important to understand exactly what you're getting involved with. Another very important thing is doing your due diligence on the company and the exact fund that you're investing in. So you want to take a look at the past fund performance, the company performance. You want to make sure that the executives of the company are real estate professionals and know what they're doing. They're in the business of professionally managing real estate assets. So you want to have full faith that they're going to operate the business as well as possible. Coming from there, we'll kind of get into how you can access REITs. And there's two different avenues that you can choose from. So there's the public market, or there's the private markets. So public markets they're very similar to private markets. The only difference really is that public markets are traded daily on a stock exchange. There's a resale market, so you can buy it one day, sell it the next. All of the company's financials are listed, it's public knowledge. Private investments are different in the sense that they're not traded daily. They don't always have a resale market. And they're not as highly governed. They do, however, have to offer up their financial statements once a year to the Securities Commission. But again, it's just sort of what you're looking for. So to give you an idea of the public and the private market, this is a graph that goes back to December of 2007. It's demonstrating the S&P TSX index, what we know as public markets. So as you can see, it's quite volatile. You see the dip in 2008 when we had the financial crisis, and then you can see over on the far side of the screen, most recently, the effects that COVID had on the public market. If you want to get involved with lower risk returns, there's something called a GIC. GIC is showcased at the bottom there. So with GICs, they offer a fixed rate and a fixed return, but after inflation and taxes, your returns are pretty much marginal or in the negative. So
negative. And that's a very conservative figure for inflation, if you
exactly taking inflation into account. Exactly. So the public market is great and you can make a lot of money off it, but it has a lot to do with timing of when you get in and when you get out. Because if unfortunately none of us have a crystal ball and we don't know what is going to come. None of us foresaw the COVID pandemic, and none of us saw the fall and the recovery of the
maybe Bill Gates. No, just kidding.
Yeah. So again, REITs offer stability and diversification into your investment portfolio. So now getting a little bit further into exactly what the private markets are. So again, it's very similar to public markets, just not traded daily on a stock exchange. Prior to 2016, only institutions, so that could be banks and pension plans, and a select few high net worth individuals had access to these products. But today, almost everyone has access to them. Most people just don't know that they're available. What these private equity investments are going to do is help add diversity into your investment portfolio, as I mentioned, and it reduces the volatility from the public market holdings that you have. So just to give you an idea of how Canadian private apartments or REITs have performed. So demonstrated in gray there, that is Canadian equities. So you can see back to 2008, there's been some highs, some lows. You know, going forward to Q1 of 2020, they were actually down. Canadian equities were down 27.5%. They have recovered slightly since then. So year to date, they're still down about 6.8%. Public REITs were down at Q1, 20.3%. And Canadian private apartments were actually up Q1, 1.6%. So you
Rose,
can see.
sorry for interrupting. I just have a quick question. So just for people to understand, when we say a public REIT, is it just for ease of understanding? Does that mean that that REIT is managed by a public company? So
Yeah,
a company that's traded on a stock exchange.
exactly.
Okay,
exactly.
as opposed to a privately owned company that, you know, does
That
not.
isn't traded daily on a stock
Okay,
exchange,
very
right?
simple. Okay, yeah.
Yeah. So again, the issue with, you know, the public market and public REITs is that they move in tandem. So when the public market is down, everything's down. So public REITs move in tandem. So it's not really an accurate reflection of the value of that asset, because that real estate value actually didn't go down, but because the economy is being affected and the public market is taking a hit, it moves in tandem. So it's just much more volatile and unstable, the public market. And, you know, private REITs offer that stability in your investment portfolio. So this is a bit of a busy slide, but this is just kind of demonstrating Canadian private apartments in relation to some other well-known asset classes. So we've got Canadian bonds in there, Canadian equities, US equities, emerging markets. So as you can see, Canadian private apartments showcased there in orange. There is the smallest amount of variance between the highest years and the lowest years. And actually the average return, which is the middle number there, actually outperforms most of these other well-known asset classes. So again, it's you know, you looking at emerging markets over there on the right, you can see, you know, there's an 82.3% chance.
That's not okay,
return.
please.
You know, and
Rose. Sorry, Rose.
Unfortunately,
Anthony,
you know,
please.
With private REITs, you're not going to be able to see something that significant, but at the same time, you're not going to be in a situation that your portfolio could be going down 41.4%.
Right. So, yeah. Not everybody has the stomach for that kind of volatility. So
exactly. It's a big gamble, right? So Canadian private apartments, they offer a lot of stability and diversification, and you want to just make sure your investment portfolio is spread out across the board. So have some in bonds and equities, and then some in private alternatives.
And you're going to explain to us where we're at.
Yeah.
So maybe you can talk about how, you know, and why this conversation is so much, you know, why we're even having this conversation today, because up until 2016, this type of investment was not even available to regular people. Like you had to be a high net worth individual, or you had to be an institutional investor.
An institution, exactly.
And you can, so in other words, you have to be what we call accredited investors, which are what's described here on the left.
So actually almost everyone can have access to private investment.
Prior to 2016, but
exactly.
Then there was
so prior to 2016, you had to be an accredited investor, which is very a high net worth
you
individual.
Can see what that looks
right?
like over there, guys. You know.
So today, fast forward today, and almost everyone can have access. There is still a qualification process, and that more so just determines how much you're limited to investing within a 12-month period. So accredited investors, as we mentioned, are high income households and earn either over $200,000 alone or $300,000 combined with a spouse, net financial assets of over $1 million or net worth of over $5 million. Eligible investors, which are the most common investors I see, if you have to have a annual income of over $75,000 alone, or a household income of over $125,000, or a net worth of over $400,000. And then if you don't qualify as an eligible, you can qualify as something called a non-eligible. And when you're non-eligible, that just restricts you to investing a limit of $10,000 within a 12-month period.
And these limits are set by the OSC, correct, Rose?
Exactly. Yeah.
Ontario.
And that's just to protect the investors' needs, right? So there needs to be some oversight. So they want to make sure that it's all done and scheduled.
Mm-hmm.
So now let's get into more about real estate. I've kind of explained to you the differences between the public and the private market. So now getting into real estate and how that relates to investing. So it's very important to note that not all real estate is created equally. We can categorize real estate into 5 different asset classes. So there's multi-residential, which is apartment buildings, commercial, industrial, development, and then real estate lending. So all of these categories behave very, very differently in the risks and the rewards and the cash flows they offer. So just some benefits of investing in real estate. So first off, it offers you income. They're a hard asset. It's a tangible real estate asset that you're investing in. There's room for capital growth, capital preservation, inflation protection, and leverage. You can always take some money out of a property that you have. You know, if you built up your equity, you can take that money out and use it elsewhere. So just getting into one of the categories of real estate, development. So development is essentially the process of converting raw land into real estate. So I don't know if you or anyone you know has ever purchased a pre-built home. You know, it's a great opportunity to get in, but essentially you hand your money up front and then you don't see anything until the project's completed. And there's always, you know, setbacks, there's delay, there's a lot of moving parts. So you need to be prepared to pass over the money up front and then not see any cash flow or any return until the project's completed. And you never really know when that's going to be. So there are nice big payouts possible with development. It's just, it needs to fit your objective of not requiring the cash flow in the meantime.
That's right. And there are people who have, let's say, high-paying jobs. They have another source of income, so they're not relying on the cash flow from real estate to sustain their lifestyle.
Exactly.
In those cases, investing in that sort of project may make sense. You know,
absolutely.
You know.
So another category is real estate lending and financing. And essentially, lending is generally a fixed term for a fixed rate. So it's very important to know with lending who exactly you're lending to and what you're lending on, because a lot of the time your entire investment relies on one individual person and then one asset.
Property. Yeah.
So exactly. So this could be a loan, a development, whatever it is. You need to be aware of exactly what it is, and who you're lending to, and what's it going to look like in a worst case scenario.
And Rose, if I may say, we had someone last week talking about private lending as a potential investment, and she's somebody that specializes in matching, you know, people who are willing to lend their funds to people who are looking to borrow private funds. And she explained the whole process. And absolutely, you know, and in her case, she doesn't even get into third mortgages, like third position mortgages, because she considers that too risky. So for her, it's first or second, and she lends on, you know, residential real estate in good locations, and she does some of that due diligence for the clients. Of course, at the end, it's still your money. You still have to do your own due diligence. But if people have more, you know, questions about the area of private lending, I invite you to check out last week's webinar. Okay. That's all.
Yeah, no, absolutely. And lending is great in the sense that it does offer cash flow generally. So if you are looking for cash flow, unlike development, lending generally could offer you cash flow if that's what you're looking for as well. Mm-hmm. So the last real estate category I'm going to touch on, and my personal favorite, is apartment buildings. So to give you an idea of why to invest in apartments, I mean, first and foremost, everyone needs a place to live. You know, even during financial crises, people are going to stop going on vacation and stop eating out, cancel their Netflix subscription. But at the end of the day, everyone needs somewhere to live, right? So it's a product of necessity. Nowadays, also, it's much more acceptable to rent forever. You know, 10 years ago, it was, you know, you wanted to buy a house, interest rates were high, you wanted to pay down your mortgage and live mortgage free. And nowadays that's not really the case anymore. It's much more acceptable to rent and not have to deal with the hardships of owning your own home. And it's actually cheaper to buy existing buildings versus building new at this point. And historically, apartments have actually outperformed all other real estate categories. So just to give you an idea of how apartments make money. So there's income and cash flow. So the apartment buildings have tenants living within the units, paying monthly rents, which is offering the investors cash flow. In addition to that, it's paying down the mortgages and increasing the equity on the property. So it's effectively paying the mortgage for you. And all the while, the building and land value continues to rise over time. So again, just to give you an idea of how Canadian private apartments have performed over the last 35 years, you can see that there hasn't been one negative year in over 35 years. You can even see the updated graph there on the far side with COVID. And we actually have yet to see a negative year. So even during financial crises, it's still positive, which is pretty amazing.
Mm-hmm. Yep.
So now I'm just going to touch on sort of my expertise, and I obviously work with Equiton, so I'm a bit biased and really believe in our products
now,
here.
you're going to tell us a little bit about the company itself as well, in addition to the funds that are available?
Oh yeah, absolutely. Okay. Absolutely.
Okay.
So we established our residential fund back in 2016.
When it was allowed to be established,
exactly,
basically. Like
exactly.
When the market opened up for what we could call retail investors. So, ordinary Canadians could now have access to this sort of assets. So that presented the opportunity for a company like Equiton to start being able to raise capital this way from investors like you and I,
So fast forward to today, we've acquired a bunch of different properties. Over this time, we're up to 19 different properties, 10 different communities. Our loan to value sits at 51%, which is actually very low. We have we're able to have up to 75% loan to value, and we only have 51, so we don't carry a lot of debt. Our average mortgage rate on the properties sits around 3%, and the properties are 98% leased out. So here's just...
Sorry for a second, Rose.
That's okay.
In last week's webinar, Susan, our guest, also explained the concept of loan to value, in case anybody watching is not familiar. But essentially, if the property value is 100%, their loan to value, in other words, their maximum loan is an average of 51%. In other words, they still have a lot of equity in those properties. So that actually is a safety blanket for you as an investor, because they're not overly leveraged. They're not just sitting on a little bit of, like, first of all, by law, they, as Rose mentioned, they should have about 25% equity. They're allowed to have up to 75%.
So up to 75%, yeah.
But they're at 51%. So that actually, as an investor, that gives you peace of mind, because if something were to go bad, I don't know.
We have a lot of capital available.
Exactly. Like even if the building's values were to go down, even quite a bit, which is very unlikely to happen, because, as Rose may explain, the building values are actually a function of the rents that get collected. But in any case, they have a lot of security blankets. At least at Equiton, that's not going to be the case everywhere, but
exactly, and that's something that's very important for investors to understand when they're choosing which company to invest with. Seeing how much debt they have, and if they're really, stretching themselves too thin with the debt to cover the expenses. So for the residential fund, as I mentioned, we've been up and running since 2016. We've seen consistent growth since then. I'll get into that in another slide. These are just some examples of some of the properties we bought over the last few years. So our target market here is, we're not going for the penthouse, downtown Toronto, 100-story buildings. We're not going for, low income or student housing either. We want to appeal to the average citizen, close to schools, close to work, close to their families, where people have a need to live. So all of our properties are all within Ontario. It'll always remain within Canada fully. At this point, we're only throughout southwestern Ontario. We just haven't had a need to go beyond Ontario, just because there's so much
opportunity.
There's so much product here. Yeah, there hasn't been a need to go, just because there's so much opportunity. So it'll always remain fully within Canada. So essentially, the strategy with our residential fund is it consists solely of income producing existing apartment buildings. And these are all tenant occupied. So we target underperforming and undervalued existing apartment buildings in Canada. So upon purchase, we actively manage these properties, and we want to unlock hidden value that most of these private owners don't see and just don't know how to operate them properly. So just running them with professional management, can make a huge difference. So some of the highlights of the fund, So our targeted returns are 7 to 10% annually, and that's net of all fees. A lot of our competitors do advertise gross returns, so it's very important to, compare apples to apples and not an apple to an orange. So, if you invest $10,000, you're purchasing exactly $10,000 worth of shares. All fees and everything have already been taken into account. The minimum investment for the residential fund is $10,000. I know a lot of our competitors, you need, $50,000, $100,000.
25 at least, yeah.
Yeah, to be able to participate.
30.
So we do have quite low minimums. Another great thing about our funds is that they are, obviously cash investments are welcome, but they're also eligible for registered plans. So this could be RSP, TFSA, LIRA. So you could utilize those funds that are sitting there, that you can't even access.
If you have GACs at the bank or even mutual funds at the bank and you're looking to diversify, and you're wanting to give yourself some exposure to a solid type of real estate investment. It's just, as Rose explained, some of the benefits. I myself am, from all my studying over the years, I'm a big fan of apartment building investing. They're a very stable type asset. They've stood the test of time. These are the types of assets that get passed from one generation to the next because you're inheriting a cash cow, and
and you just want to make sure you're diversified, right? It's a lot of people have RSP sitting in the bank, making 2% annually, and then what they don't realize is they're actually paying 3% in return. So they're actually losing money. So you want to make sure your money's working for you.
Because of the fees, the mutual funds, we already covered in another webinar that talked about the added cost of the fees at the end of the day. But the beautiful thing about being able to invest inside a tax shelter vehicle like an RSP or a TFSA is that you're not paying tax on these returns at the end of every year. The returns stay inside your tax shelter investment vehicle, and they just keep growing.
Exactly. And these types of investments, REITs, there's a compounding aspect to it. So what that means, the longer you hold your investment, the larger your returns grow. So especially with RSPs or LIRAs, you're not even be accessing that for a few years. So why not invest that somewhere you're going to receive compounding and really see the progress on that money. Another thing to mention also is, I know you mentioned that the tax advantages of using registered funds in investing. Our residential fund is something that's called 100% return of capital. So what that means is that it is fully tax deferred, and this is something that is specific to Canadian private apartments. So how it works is, even if you're taking that monthly cash flow, tax is fully deferred. You will not see an annual income statement for your tax until you sell at the end of the hold of your investment. So whenever you choose to sell, at that time, you're then taxed as capital gains, which is the best way to be taxed on an investment.
Right, Rose. So I just want to make it clear for people. So this would apply, let's say you're already maxed out in your RSPs, or you have them invested in something that you're already happy with and you want to stay wherever you are, but you have some money outside of an RSP or a TFSA that you're wanting to place. This would be a very tax advantage investment vehicle because, as Rose explained, the money, the distributions that you'd receive, which is akin to an interest payment every month. As you can see, it's monthly distributions. It would be treated as return of capital, so you don't actually have to pay any tax at the end of every year. Finally, when you decide to sell your shares in the REIT, also known as units, at that point in time, you would pay capital gains tax on whatever growth has taken place in the value of those shares. So if you invested $10,000, but now those shares, thanks to the growth in the fund, those shares are worth $15,000 and you sold them, you're going to have to pay capital gains tax, but that is a preferential tax treatment. It's not fully taxed. It's 50% or 50% roughly would be taxed, and that's depending on what your tax bracket and so on.
Exactly. And something else that's important to note is that you can also invest through a corporation. So if you have a holding company, a corporation, you can use those funds that are just sitting in there, you can invest them, and have that money making money for you before you want to pull it out from the corp. So there's a lot of different options of how you can participate in investments such as this. We do offer a reinvestment program. So as I was mentioning, we offer monthly cash flow, also known as a distribution or a dividend. So if you're looking for cash flow each month, you can take that cash flow. If you just want growth on your investment, you can elect to reinvest the distribution. So this is just an automatic transaction. Those funds are used to purchase additional shares, and then we actually offer a 2% discount in the share price. So that's going to offer you even further compounding. That's where you're going to see the best growth.
And Rose, people may be wondering what kind of commitment, because when we spoke about private mortgages, for example, and private lending, Sue, our guest, explained that it's usually a 1-year term. Sometimes it could be a 2-year term, but it's usually a relatively short-term investment. It could be 6 months, a year, 2 years maximum. And then they would have to essentially find another property to lend against. So with you guys, can you tell people, is there a certain length of time that they have to commit their funds for?
So with most real estate investments, a 3 to 5 year suggested hold is recommended. I mean, with real estate, you're not going to go out tomorrow and buy an apartment building and then sell it the next day. That's just not how it works. So for best results, you want to be able to hold it for at least 3 to 5 years. Saying that, we do offer redemptions whenever you want. So it's considered liquid. All we ask is 30 days written notice, and then redemptions are made on the 15th of each month. So there are some redemption fees associated to redeeming prior to the 5-year mark. But they are on a sliding scale and decrease every year. But if you're looking for an investment that's just a 1-year hold, this wouldn't be best suited for you.
Thank you for clarifying that.
Yeah,
and on that note, Rose, sorry for interrupting. I just want people to know that oftentimes when people buy, invest in mutual funds in their RSP or outside their RSP, there are also these redemption charges if you pull the money out. Usually it's a 7-year declining fee schedule, also called as DSC, deferred sales charges. So oftentimes, without even telling you, whoever is offering you that investment may put you into this type of schedule, and you're not even aware that when you try to pull the money out, oh, by the way, there's going to be some fees.
Yeah, no, exactly. And we, here at Equiton especially, we're very transparent. We like to under-promise and over-deliver. So we're very clear when it comes to fees. Targeted returns. Our targeted returns are very modest. So we do like to be very transparent with all of our clients so they know exactly what they're getting involved with.
Now, explain to us, what is this targeted return? I mean,
so the targeted return is something, when you start raising capital and you have a business plan, that's something you're obviously going to have a targeted return. So as I mentioned, so for the residential fund, there's 2 different ways that you're making money on your investment. There's the monthly distribution. So the distribution is 6% annually and then offered monthly. And then in addition to that, there is something called increase in share value. And what drives the increase in share value is capital appreciation. So, every year the properties are getting reappraised by third-party appraisers, and they're always increasing in value, especially because we do target these underperforming and undervalued properties.
Then you add value.
Exactly. We're adding a huge amount of value. Yeah. So currently for our residential fund, we're at 9.77% net returns, and we're growing like crazy. So, and another great thing is we actually haven't seen a decrease in share value since inception. So
you've had an increase in the share value since inception.
We haven't seen a decrease in share value since inception.
A decrease? What do you mean? Sorry. Oh, you haven't seen
a decrease. So
our
share value has not gone down.
Sorry.
The value. Yeah. I know it's a lot of finance mumbo jumbo, but
no, I got it.
Again, a very, very stable investment.
Yeah.
So just to give you an idea of the fund growth since inception. So in 2018, we increased by 300% in size. 2019, we almost tripled again in size. And this year, we are on track to reach $300 million in assets under management. Currently, we are at $225 million. And that is equates to 960 doors total.
Okay, so this is the value. Sorry, Rose, just for me to understand and for our audience to understand, this is the value of the real estate assets, right? This is not the value of the REIT. And then I guess what I want to know, because one of the objections that I get, and you might have heard it too, is that, well, you don't directly own the real estate when you're an investor in a REIT. So I guess pretty logical question, and I'm sorry I should have asked you this on our practice call yesterday, is there any protection of capital for these investors? I mean, what's kind of
yeah, that's a great question. So all of the assets, again, are within a trust. So the investors actually own a shared pool of all those assets. So say, worst case scenario, the company that operates and manages this real estate trust, they go out of business, the assets are still protected within that trust, and all the investors have a shared pool of ownership. So they're investing in, that $225 million of real estate assets. They have ownership in those.
Interesting. Okay. Yeah. So
and all of those buildings, so 960 doors, there's 960 tenants living behind there paying rent each month, and right. So it's generating monthly cash flow, and then all the while the increase in land value goes up as well.
So I guess my question is, and again, it's a bit of a technical question, but let's say Equiton is the corporation, they own the apartments, and then the REIT.
So Equiton wouldn't own, it's within a trust, right? So the trust is Equiton Residential Income Fund Trust. That is, all
that
of
is
the
who
investors.
Actually owns the assets? That is who actually owns the assets?
Yeah, so because it's a trust, the investors have a shared pool of ownership of those assets.
Okay. Thanks for clarifying that.
Does that make sense?
Yeah, I mean, I get it.
So we oversee, what's being acquired, and if we haven't to date, we haven't sold any of our properties to date, but that doesn't mean if the right opportunity came around that we wouldn't. Financially, if it made sense, we would. So obviously, there's oversight. We have 5 board members.
And you're going to get into that.
Yeah. I'll get into that in a little bit. Exactly.
Good. Okay.
So quickly, just some more fun results. So since inception, we've had positive and increasing returns for both our unit price and our distribution. We've never failed to make a redemption request, and we've never failed to make a distribution payment.
Good to know.
Sorry.
No, I just said good to know. That's
okay. Yeah. And that's the most important thing to do with any investment. Whether you're doing public investments, private investments, you need to look at the past company and fund performance, right? Past history is going to be the best determination of how it's going to perform in the future.
Well, they usually in those mutual fund pamphlets, as a disclaimer, they always say past performance is not an indicator of future results. But I mean that's really one of the few things.
Nowadays, the public investment market, it's gambling. There's no guarantees anywhere, and you can, I'm passionate about investing on public and private market. It's a personal hobby of mine, but it's extremely hard nowadays to know what you're getting involved with, because it can have great past company performance and then next year it's kaput. And but there's not much else to go on. You need to do your proper research, make sure the executives know what they're doing, that they have experience in whatever industry or sector you're getting into.
And I actually like the option that a REIT presents, including your REIT offerings, because you actually know more about the investment versus when you're investing, let's say, in a mutual fund portfolio. I mean, that's very much out of your hands. Like, you don't get to choose which individual stocks get picked.
Oh yeah. For public investments, nowadays it's all, these emerging tech markets and tech this and Tesla and Apple and Peloton, and it's
and there may be opportunities there too, but very few people actually know to stock pick, and ultimately we leave that to professionals. And
of course.
What I like about at least adding something like this to your portfolio as a diversification tool is that you get to learn quite a bit about what this fund actually invests in. You get to learn who manages it. To me, it's more solid than
it's literally a
they don't have any control over, or very little control.
Exactly. So just some more metrics for you. So our operating revenue this year has increased by 88%. Net operating income, we're up 104%. Loan to value, 51%.
Now, is that over? Is that over same time last year, Rose, or?
Yeah, so 2020 year to date. So just from, January.
100% increase over last year?
Yeah.
And that's because you guys acquired some new buildings, didn't you?
Yeah, and I'll get into that, but we have acquired, we got a new one in Q1, and then we also picked up one in Q2. So I'll get into that in a couple slides.
Okay.
Again, just some more portfolio mix. So you can see most of our units are in Southwestern Ontario. We've got some GTA and some Eastern Ontario as well. And then just some average rents by suite type what on average we're renting the units for.
And those are, I would say, pretty, but that's, compared to GTA rents, those seem low, but you are also in other markets within Southwest.
Oh yeah, I mean, again, like we're going, we don't want to be over saturated in any one market. Like look at the Toronto market right now, right? Apartments have taken a pretty bad hit, but out in London, that's not the case. So you want to make sure.
I wouldn't even know about that, Rose. Like, did they take a bad hit? I don't know.
Yeah, no. So I mean, this entire COVID experience has really made people see that their 1-bedroom studio apartment with no balcony downtown Toronto isn't as great as they had thought it was going to be, and they're all moving outside of the city so that they can have a bit more space. So
because of telecommuting, people being able to now work from
remotely, and yeah, exactly. I mean, Toronto is just, so busy, and if you can't actually do any of the fun things that come along with it, why bother living there? So again,
I understand.
The market in London doesn't have that because there's a lot of space and room in London.
So we may actually see, if anything, we may see rents going up in some of these secondary markets.
Yeah, no, absolutely.
Yeah.
So to give you guys an idea of some of the properties we have, as I mentioned, we picked up a property in Q1 located in the Beaches in Toronto. If you're not familiar with that area, it's in the east end of Toronto, very up and coming. We picked up that building for 19.9 off market. And then upon purchase, there was an automatic 11% increase in value when it was reappraised. Just because we were able to unlock so many hidden values.
So you picked it up for 33 million. You said 19 point, no, not 33 million, I guess.
So yeah, sorry, that I was talking about our other property we got in Q1. This wealth property, sorry, that was confusing. We picked up in Q2, so we just purchased it in July of 2020.
Okay.
So we purchased it for 33 million off market. So purchasing something off market allows you to avoid competition, and B, get it for a better price. So upon purchase, we always reappraise our properties upon purchase, and it came in at 33,040,000. So a slight increase in value just overnight, essentially. The rents are 11% below market right now. We got a great mortgage rate at 2.17%. We were able to get very cheap capital. Yeah, exactly. And the units are 99% leased out.
The buildings look beautiful. Like that doesn't look like a building that needs a lot of work to me. It looks like almost new.
And that's one of the efficiencies of getting a newer building. And we actually have another complex in Guelph located just down the street as well. So we're very familiar with the demographics here, the rental market in the area. So it was a no-brainer for us to pick this one up. Here's another property within the fund. So this was actually a very big purchase for us last December. It was our largest acquisition to date. We purchased it for 47.2 million. So the rents were 60% below market rents. This is because there has been a lot of tenants that have been in there for long term. A lot of them are older, which means that eventually they are going to be moving out and going into, retirement homes and moving into family. Yeah, unfortunately. So at that time, we'll be able to go in there and make any updates that is required, and then raise those rents up to market rent.
And another issue is, Rose, which any real estate investor that has had any training will know, is you want to take advantage of those small annual rent increases that the landlord tenant board allows. Even if you're in Ontario, where we are in a province that has rent control, what can happen is landlords who don't know better, or building operators that don't know better, will not raise the rents for years and years. And in the end, that's how you get to this sort of situation where rents are so far below market, because people haven't been keeping up with at least the rent increases that they were allowed to do. Don't you find, Rose?
No, I mean, absolutely. And that's something that comes into, again, by professionally managing these buildings, the value we're able to unlock by just doing little things like increasing the rents.
You have every right to
this building,
the rents,
This one, for example, they were able to charge for parking, and they weren't charging anything. So, we were able to get $100
money on the table
per parking spot. So, the parking was 100% below market, and the building was 99% leased out. I mean, it's located in central Mississauga, right near the subway lines, the malls. It's a huge desirable area. So we were super excited to pick these two up. They're actually, both buildings were included in the purchase there. This is our London property. We actually purchased this property back in March of 2019. We picked this up off of a developer who was in the business of development and had no interest in running apartment buildings. So it was super efficient because it was brand new. So didn't need any new appliances, didn't need a new roof, no new furnace. London's got a great rental market. There's a lot of baby boomers there, a lot of old insurance money. So now a lot of people are looking to downsize from their family homes into a bit more of an efficient lifestyle.
1 second, guys. Anthony, can you please open? Keep this door closed. Sorry, guys. Working from home.
I know. Files and
Close that. Thank you. Okay. Go ahead, Rose. Sorry about that.
Yeah, no worries. So yeah, London has a great rental market there. We were able to get a 3.2% mortgage rate. And it's got some really nice luxury features within this unit.
I can see that.
This is our Markham complex. So this is actually one of my favorites. So we purchased this complex for $21 million back in March of 2019. It was reappraised upon purchase, and now up to date, it was just reappraised at $25.4 million. So that's an increase of $4.4 million, in a matter of a bit over a year. So this property we actually purchased off a institutional investor who was very hands-off on running the property. They bought it as an investment and then had other people managing it. And 25% of the building actually was contracted out under a short-term rental contract. So that would be something similar to Airbnb. So 25% of the building was under the short-term rental contract. That came at a price of $200 per door. So that was per month also. So that was a huge expense, completely unnecessary. So luckily for us, upon purchase, that contract was expired. So, we got out those short-term rentals, moved in full-time tenants, and this complex has been great for us. It's been increasing in value, and Markham is a very busy area that has a lot of demand.
Yeah, when I think of Markham, there's not a whole lot of apartment buildings in Markham to begin with. Yeah, that's an area that it's mostly residential and commercial complexes, but there's literally not too many places unless somebody's willing to buy a home, and homes have become increasingly expensive. So I can see how Markham would be a good rental market, because if anybody wants to live in the area and they can't afford to buy a home, or they don't want to for whatever reason, maybe they're there for work, they don't know for how long, of course.
Yeah, and a lot of people just don't want to take care of a house, right? If apartments are efficient, they're easy to live in, there's underground parking, stuff like that.
And this is a beautiful building. This would be a condo equivalent.
Yeah, no, absolutely.
Yeah.
And so as I mentioned earlier, for all investments, and especially private investments, it's very important to have fund oversight. So these are our board members who govern the funds. So they go over annual strategy, budgets. They go over, what's going to come for the following year, how our financials are doing, just in constant communication. So they're all real estate experts by right, and 3 of them are external from Equiton.
Okay. Just one more thing I wanted to say, guys. As you were showing us all those buildings, and people are looking at the numbers, and it's like 47 million, 25 million. These are figures that if you're, a regular person, you're thinking like, oh my God, well, this is the opportunity that investing in a REIT presents. It essentially gives you access to these types of assets that you as an individual would not, in all likelihood, you would not have the funds to purchase this size of a building, because the size of down payments that are required to acquire that level of asset. Of course, there are strategies in apartment investing, and there are people that teach that, how to become an apartment investor. And of course, you're welcome to pursue that as well, should you choose to. But for people who are simply wanting to benefit from the benefits of this sort of asset without having to come up with the millions that are required as a down payment, this is the opportunity that a REIT presents.
Of course. And a lot of people want to invest in real estate, but unfortunately can't afford the big down payment, or they don't want to deal with the hassles of being a landlord. So this, allows the opportunity for you to participate in real estate investing without all the hassles that come with it. We established our balanced real estate fund trust at the end of 2018. We established this fund just as a alternative to our residential fund. Our investors were so pleased with how the residential fund was going, so we wanted to have another option for them. So there's 3 different real estate investment categories within the balanced fund. So there is income producing commercial properties, there's real estate lending and financing, and there's development and construction projects. So the concept with this fund is, you're going to spread out the risk, diversify the risk across multiple asset classes. Because you have those 3 different components, you get those nice big payouts with the construction and land development, but you also receive monthly cash flow from the commercial properties and the real estate lending and financing. So there's very attractive total risk adjusted returns. So we're still in a period of raising capital for this fund. The original unit price was $9 a share, and then when we hit $5 million in capital raised, we are increasing the share value by 10 cents each 500,000. So the investors who were lucky enough to get in the beginning phases have already experienced a couple of increases in the last few months. And we do actually have one lending deal within the balance fund, and that allows us to be able to currently offer our investors a monthly distribution, which is the exact same as their residential fund, 6% offered on a monthly basis. And then, sorry, I'm just going to go back to this one here.
No problem. Okay.
And then again, you can elect to either take that distribution each month as cash flow or reinvest it if you just want growth. And then when you reinvest it, you get that 2% discount that's going to offer even further compounding. So the balance fund does have a larger overall target return than our apartment fund at 8 to 12% net. Mm-hmm. It has a lower minimum investment of just $5,000. It again is available for cash, corporations, registered funds, monthly liquidity options. So yeah, now at this point, we have funds available to deploy into the right assets as they seem fit. So currently we're actually in the process of looking at some commercial properties and development properties. So our acquisition team is ready to deploy those funds as soon as they find an asset that looks good.
Okay.
And again, the balance fund has 5 board members, 3 of whom are external from Equiton, go over the annual strategy, budgets, targets, all that stuff, which is very important for the investors' needs.
Got it.
So now just to touch quickly on exactly why, now you know why investing in real estate is great and all the ways it can make you money, but why Equiton and why partner with us. So first and foremost here, we're real estate professionals. The team of executives have managed over $10 billion in real estate assets, over 10,000 apartment buildings. They've developed over 100 million square feet and have a collective over 100 years of experience. So, that's where our expertise lays, first and foremost, real estate professionals. So, that expertise allows us to do a number of things to make sure that we are buying these properties right. A lot of people just think it's location, location, location. And though location does play a big part in it, it's also extremely important to note, the demographics of that area. We don't want to target somewhere, a city that only has one major industry. And if that company goes out of business, no one's going to be able to pay their rents. So you need to know about the city, the marketplace, the demographics. Yeah. So a lot of discipline and multi-stage research and due diligence goes into this. And that's sort of what we specialize in here. So again, it all seems like a very easy concept, real estate investing, but it's a lot of hard work and it requires, day-to-day active management. So that could be increasing rents, finding the right tenants, increasing non-rent revenues, as I mentioned, parking, laundry, lockers, making sure the tenants pay for utilities, Wi-Fi thermostats, so on and so forth. So to give you an idea also of what we're looking to do to these properties upon purchase, we're really not looking to, buy complete tear downs and tear them down to the studs and rebuild. That's not the case. Ideally, we're finding buildings with good bones and just need some TLC and some updates to the aesthetic. So this example, we got some new appliances, new coat of paint, new cabinets. It goes a very far way.
Then that allows you to, but just want to make it clear for people, that allows you to then charge higher rents for those units, which
absolutely
ends up reflecting in the building value, and it reflects in the cash flow that you're able to generate from that building, which will then be returned back to the investors.
Exactly. So, you know, a little bit of an upfront investment to do, you know, minor updates goes a long way. This building, for example, this is our Brantford complex. So that complex is located right across the street from a hospital. So a lot of our tenants there are healthcare professionals. So it did, in this case, make sense for us to pay a little bit more upfront. So we included stainless steel appliances, mosaic backsplash, granite countertops, to attract that tenant base because we knew it was there. So a renovation like this would cost us about $7,000, but it would actually equate to about $250 a month in additional rent. So it's a very quick return on investment. So just to touch quickly on our property management, we actually this year brought the property management in-house. We've reached a size in assets that it actually made more sense for us to bring it in-house. So Equiton Living is our property management company. So, you know, now we have entire oversight of the entire process. And so that's it. So, you know, the secret's out, and you know, maybe you didn't know you had access to products such as these. You know, there are public REITs, which, you know, offer great rewards. And now you know a little bit more about private REITs and sort of the benefits that come along with them. Yeah. And it's, of course, you know, you may have thought all real estate was created equally, and that's really not the case.
Yeah.
So if you're interested in learning more, anyone, or if had any questions at all, you can reach out to me directly. You know, Letitia can pass on my contact information, and
or there it is. Rose is one of my partners. So Equiton is a company that you know, I know of for quite a few years, and I know people in my network who have definitely invested their RSP funds with them, for example. So I felt comfortable bringing someone like Rose in. It's a company that many of us in the real estate investing community have known about, and again, I personally I'm a fan of apartment investing. I truly believe in this asset class. If they were, now again, you have the option with them of investing in the other fund, their development fund, and to me that is a little bit higher risk because you're doing active development versus investing in something that's already built and it's there. But again, it depends on your risk profile, and if you're trying to offer yourselves, you know, exposure to a more diversified pool of real estate assets, they give you that option as well, as you can see. And again, there are maybe a handful of other REITs that I'm aware of that are similar to Equiton. They are the ones I know about are Alberta based. I figured, especially investors, I know most of you in my audience are from Ontario. And now that being said, I know some of you are from other provinces. So Equiton does accept investors from across Canada, correct, Rose?
Yeah, no, absolutely.
Yeah, unfortunately, they're not able to work with Americans right now. It has to do with the legislation, OSC rules, all that kind of stuff.
Yes, we can offer investments to foreign investors, but not USA right now, not at this point. So there's like just a couple other steps in the process, but it's just essentially signing a form. And
adds too much. I see. In other words, if you are a
foreign investor, yeah,
foreign investor. Not most Malians are, I would say, Canadians, maybe some Americans. But anyway, again, you could be anywhere in Canada, and you have the opportunity to get involved with this type of investment if this is something you wanted to add to your portfolio. Again, what I like about it is, again, the returns are obviously superior to something that's a fixed income type investment, such as a GAC. And at the same time, you are getting those monthly distributions, which again, if it's outside of a registered investment, it can be done in a tax advantage way with the return of capital option. Or if it's inside a tax shelter vehicle like an RSP or a TFSA, you don't even have to worry about, you know, you're benefiting from that compounded growth. So you can expect to see, you know, based on the performance that we've seen so far, Rose, and what I also know, and by the way, like, I know the kind of returns that can be made with apartment investing. So Equiton is being very conservative with the returns that they're promising, because I'm aware.
Yeah, and as I mentioned, you know, we want to under promise and over deliver. We're not here to, you know, make these huge promises and not be able to fulfill it. So
they're being very conservative. That 6% distribution, again, I think it more likely, as you said, like you're currently, the share value is like 9.9. The growth has been. The
distribution will stay at 6%. That's actually a very competitive distribution, even on the public market, private. But what's going to continuously increase is the share value as well.
Yeah. Okay, Rose, well, thank you so much again for joining us. I'm gonna, if you could now minimize your slides, if you do me the favor. Everyone, if you want to reach out to Rose, please feel free. Just mention that you heard about her on Letitia's webinar. Thank you very much. And yeah, Rose, if you could please minimize the slides, and I'm gonna go back on Facebook to see if there were any questions.
Okay, sounds good.
Okay. Let's go back. Okay, give me 1 second, Rose. You cannot minimize when you're recording. Oh, great. I think I'm just gonna have to open another window, Facebook. Okay, let's see if there were any questions. I don't see any questions there. Just a like. Thank you very much, Karen. Okay. Well, everyone, if you do have any questions, feel free to put them in the comment section, and Rose will be happy to answer them for you. Okay. And thanks again, Rose, for joining us. And I look forward to staying in touch and seeing how we can support our mutual clients.
Great. Thank you so much again, and we'll talk soon.
Take care. Bye for now.
Bye-bye.
Bye, everybody.